Most investors believe the fastest way to get rich is by finding the next Tesla or Nvidia. They chase hype, burn cash on speculation, and wonder why their accounts look like a graveyard of bad decisions. The truth? Almost nobody beats the market. Warren Buffett put up $1 million on this idea and proved it. Over 10 years, a boring index fund crushed the smartest hedge funds in the world. That's the real game. Quiet, consistent compounding. And the best way to play it is with ETFs. They don't make headlines. They don't care about your emotions. They just keep stacking returns while most people self-sabotage. Today, I'm going to show you 4 ETFs that are built to hold forever. They're not theory, they're not hype, they're the ones that I actually own. And here's a quick update before we hit the ETFs. I'm going off-grid for a real adventure. I'm flying into Kathmandu with my girlfriend, meeting a guide who is a close friend of mine and another couple we roll with. We're grabbing motorcycles and pushing for Tibet. The target is an overnight at Mount Everest base camp. No comfort zone, just a tight crew, a long road, and a lot that can change. The main road was hammered by floods on July 8th. The Friendship Bridge between Nepal and China washed out and the border closed. There's a 9-kilometer stretch that's still impassable, although they're working on that plus a new bridge. There is one other route that might get us through. Permits, customs, and timing are moving pieces. We'll solve them one checkpoint at a time. Could we cancel the trip? Yes. Will we definitely reach Mount Everest? Maybe, maybe not. I love adventure and the unknown, and this region needs travelers and their dollars more than ever. So we're going. If we make it, amazing. If we don't, that is life with the throttle wide open. Now, I will post updates when I can find a good signal. For my patrons, I will be in the markets every night as long as there's Wi-Fi. If the connection holds, you'll get the usual alerts and breakdowns. If it cuts out, expect a short pause and then a full debrief when I'm back with a camera roll full of pictures and a story worth telling. And even if I'm not there, we have an amazing community in my Patreon. All right, back to the markets. Stock picking feels exciting. You buy a ticker, watch it jump, and believe you found the cheat code. That rush is why most people lose. They confuse luck for skill, add risk, and the account pays the price. Here's the truth. Between 85 and 90% of active managers underperform the market. These are people with teams, models, and unlimited data. The truth is, most people cannot outperform the S&P 500 over time. Warren Buffett put $1 million on this. He said a simple S&P 500 index fund would beat hedge funds over 10 years. It did. Quiet compounding outperformed complicated strategies that charged high fees and delivered less. ETFs remove emotion. They spread risk across hundreds of companies, charge pennies, and keep you in the market when fear tells you to exit. That is why they win across decades. For context, my accounts are up $1.9 million or 53.87% year to date, driven by a rules-based approach with ETFs as part of my core holdings. The takeaway, stock picking is entertainment that drains capital for most investors. ETFs are how you build wealth with consistency. Own the market and stop trying to outguess it. If there is one ETF every investor should own, it's VOO or VOO. This fund tracks the S&P 500, which means you instantly own 505 of the biggest companies in America. Apple, Microsoft, Nvidia, Amazon, all in one ticker. No chasing, no guessing, and the numbers speak. Over the last 12 months, VOO delivered a 17.06% total return. The expense ratio is just 0.03%. On a $100,000 position, that fee is only $30 a year. Compare that to active managers charging 1% or more. The trade-off? You will never beat the market with VOO because it is the market. But you also will not blow up your account trying to time earnings, bet on turnarounds, or ride meme stocks. It compounds quietly year after year. This ETF is the bedrock of wealth. If you want a foundation that is nearly impossible to screw up, VOO is the one. It is boring, it is predictable, and boring plus predictable is exactly what wins in compounding. Most investors never build real wealth because they ignore income. That is where JEPQ changes the game. This ETF tracks the Nasdaq 100 but sells covered calls to generate cash. The result? You get exposure to the biggest growth names plus one of the highest yields in the market. The numbers are hard to ignore. Over the past 12 months, JEPQ returned 16.45%, which includes a rolling dividend yield of 11.52%. That is monthly cash flow, and with an expense ratio of 0.35%, the cost is small compared to what you get back. But here's the catch. Because of its high yield, JEPQ is best held in a retirement account if possible. That way the income is shielded from taxes and you maximize the compounding effect. Hold it in a taxable account and you're giving Uncle Sam a cut every single month. JEPQ complements VU perfectly. VU compounds steadily, JEPQ pays you while you wait. Together they balance growth and income. If you want cash flow without giving up tech exposure, this ETF belongs in your long-term portfolio. If VU is the bedrock and JEPQ is the income engine, then the QQQM is pure growth. This ETF tracks the Nasdaq 100, which is stacked with the heaviest hitters in technology. Apple, Microsoft, Nvidia, Amazon, and Google all sit at the top. You are buying the innovation economy in one ticker. Performance shows why it matters. Over the last 12 months, the QQQM delivered a 21.95% total return. The dividend yield was small, 0.55%. The expense ratio is just 0.15%, which makes it cheaper than the QQQ, but with the exact same holdings, the same exposure at a lower cost. The difference compounds more than most people realize. The pros are clear. You get direct access to companies driving AI, cloud, and digital infrastructure. You are positioned in the highest growth sectors without having to pick winners. The cons? Tech concentration. When tech sells off, the QQQM takes a bigger hit than a broad index like the VU. This ETF plays a different role than JEPQ. Where JEPQ trades some upside for income, the QQQM keeps all the upside and delivers no cushion. That makes it a pure growth complement to VU. For anyone who wants to tilt their portfolio toward innovation and megatrends, QQQM is the lever. SCHG is the underrated growth ETF that does the heavy lifting quietly. It holds large cap growth names, so you still get Nvidia, Apple, Microsoft, and Amazon, but instead of focusing on just the top 100 companies like the QQQM, SCHG spreads across more than 200 growth leaders. That broader scope makes it less top heavy and less concentrated. The results are strong. Over the last 12 months, SCHG returned 21.87% with a 0.37% dividend yield. The expense ratio is only 0.04%. On $100,000 invested, that is $40 a year. For context, that is almost 1/4 the cost of the QQQM, and the compounding impact of lower fees is massive over decades. Here's how it fits. QQQM is a sniper rifle. Concentrated exposure to the Nasdaq 100, pure tech momentum, full upside and full downside. SCHG is more of a wide net, still tilted towards growth, but spread across more sectors with broader company exposure. Together they balance each other. QQQM gives you the sharp tech edge, SCHG gives you the growth with diversification and ultra low costs. The takeaway is simple. If you want tech-heavy growth with less concentration risk, SCHG belongs alongside the QQQM. One pushes you hard into innovation, the other smooths the ride while still delivering growth. Hold both and you get growth exposure that is powerful, diversified, and cost-efficient. Most investors chase hype. They buy meme stocks, gamble on penny plays, and treat the market like a casino. That is why their accounts swing wildly and rarely grow. The truth is wealth comes from boring consistency, not blind speculation. That is why these 4 ETFs matter. VU gives you the market itself. JEPQ gives you monthly income. The QQQM gives you concentrated tech growth. And SCHG gives you broad-based growth at rock bottom costs. Together, they cover stability, cash flow, and innovation. That combination is how you build wealth that lasts. Here is the key. These are not theory. These are not flavor of the month. They are core positions in my own portfolio. They do the heavy lifting quietly while I use my own indicators to time entries and exits with conviction. My accounts are up $1.9 million this year, which is 54% year to date, and these ETFs are part of the foundation that keeps the engine running. ETFs are the silent compounders. They do not scream for attention. They do not make headlines. They just keep stacking returns behind the scenes while most people burn out chasing the next big thing. If you want real long-term wealth, this is how you get it. Now let me ask you something. Who else is showing you how to build a portfolio with ETFs that quietly compound? Who else is breaking down both the bull and the bear cases, walking you through execution, and showing you results backed by actual growth? Nobody. That's why my accounts are up 1.9 million this year. These are not paper trades. This is real capital, real execution, and a process I use every single day. And it's not just me. Jungle just closed his best month ever in August, banking $23,926, mostly from selling cash secured puts and running the wheel strategy. Others in my community are stacking consistent wins, sharpening their toolkit, and finally trading with confidence instead of chasing noise. Inside my Patreon, you get real-time trade alerts with full breakdowns, entries, exits, and the whys. Daily market analysis, cutting through the noise, only what matters. Set up lists with targets and risk levels, and a private community that keeps you honest and focused when prices swing. It's only $30 a month. People blow that on coffee and DoorDash without even thinking. This is the one expense that can actually pay you back. Try it. If it does not sharpen your strategy, grow your account, and give you more conviction in every trade you do, cancel anytime. No pitch, no pressure. But if you've been watching my channel, nodding along and telling yourself I should join, this is the moment you should. Stop watching, start building. Because the truth is simple. You can scroll or you can scale, but either way, don't say you were not told.